All right, today we're jumping into something that can feel, well, a little complicated. Financial instruments. We're going to break down the key rules from IFRS 9 and make this whole thing make a lot more sense. Let's get into it.
So let's just think about this for a second. Imagine two companies. They both buy the exact same bond, but one company plans to just sit on it and collect interest payments. The other one, they're going to flip it next week for a quick profit. Now, does it really make sense for them to report that bond the same way on their books? Probably not, right? And that's the core problem, the big question that standards like IFRS 9 are built to answer. So let's really dive in.
Okay, first things first. Before we get into all the nitty-gritty rules, we've got to start with the basics. I mean, what even is a financial instrument? Let's make sure we're all on the same page.
So at its core, a financial instrument is really just a contract. That's it. It's an agreement that does two things at once. For one company, it creates a financial asset. Think of it as a right to get cash later. And for the other company, it creates a financial liability, which is an obligation to pay out cash.
All right, so what's a financial asset? Super simple. It's something you own that's going to bring you cash down the road. This could be, actual cash in the bank, shares you own in another company, or what we call a receivable, which is just a fancy way of saying you have a contractual right for someone to pay you back.
And then you've got the other side of the coin, financial liabilities. This is the easy one. It's what you owe. We're talking about things like a bank loan you took out, or maybe a bond your company issued. It's that formal promise, that contractual obligation to hand over cash to someone else later on.
Okay, this table really helps clear things up. It draws a super important line between what is and what isn't a financial instrument. So a bank loan? That's a financial liability, no doubt. It's a clear contract to pay cash. But now look at something like inventory. You might think, well, I'm going to sell that for cash. And you're right, you hope to. But it's a physical thing. There's no contractual right to cash just by holding it. Same goes for prepaid rent. You've paid for the right to use a service or a building, not the right to get cash back. It all boils down to one word: contract.
All right, so you've got a financial instrument. Now what? Well, now comes probably the most important step of all: classification. And I'm not kidding, this decision is everything. How a company categorizes that instrument will literally dictate its entire accounting story from that point on.
So how do you actually classify something like a bond or a loan? Well, it's not like you just throw a dart at a board. IFRS 9 gives us a clear roadmap, a really logical process, and it all comes down to answering two key questions.
Yeah, think of these two tests as like gatekeepers. You have to get past both of them. First up is the business model test. This one's all about why the company holds the asset. What's the game plan? Are they just holding it to collect the cash flows, or are they planning to sell it? Or maybe both? Then you've got the cash flow test. This one looks at the instrument itself. Are the payments you're getting just simple principal and interest, or is there something more complicated baked in?
And check this out. This table lays out the logic perfectly. So if your business model is just to hold the asset and collect payments, and those payments are simple principal and interest, boom, you classify it at amortized cost. This is the steady Eddie approach. You pretty much ignore the day-to-day market swings. Now, what if you plan to hold it and maybe sell it? If it still passes the cash flow test, it goes into fair value through OCI. Here, you do track market value changes, but you park them in a separate part of equity called OCI, so it doesn't mess with your main profit number. But if you fail either of those tests or your main goal is just trading, it gets dumped into the default bucket, fair value through P&L. And this one means every single price change, up or down, hits your income statement. Big time.
Okay, so what about stocks? Equity investments. Well, this is actually way simpler. Think about it. Stocks don't have contractual payments of principal and interest, right? Dividends aren't guaranteed. So they automatically fail that cash flow test. That means amortized cost is completely off the table. The default for pretty much all equity is fair value through profit or loss. There is one little exception, though. If you're not holding the stock for trading, you can make a choice, a one-time you can't take it back choice, to put it through OCI instead.
Okay, so we've classified our instrument. The next logical step is measurement. How do we actually track its value over time, from the moment we buy it to the moment we get rid of it?
So there's a golden rule for day one, and it's nice and simple. Every single financial instrument starts out on the books at its fair value. And usually, that's just the price you paid for it or the cash you got when you issued it. No complex math needed at the start.
But here's a little detail that actually makes a big difference. What do you do with transaction costs? Things like broker fees. Well, it depends on the classification. If the instrument is going through P&L, those costs are expensed right away. They hit your income statement in period 1. For everything else, though, amortized cost and FVOCI, you actually add those costs to the initial value of the asset. You capitalize them. It seems like a small thing, but it really changes the starting number on your balance sheet.
And this table right here, this is where the rubber meets the road. It shows you the consequences of that classification decision. So, if you chose amortized cost, you basically just ignore the market's daily mood swings, nice and stable. If you chose FVOCI, you track the market ups and downs, but you keep them quarantined, if you will, in that separate part of equity called OCI. They don't touch your main profit number. But if you're in the FUPL category, well, hold on tight, because every single change in value, every tick up or down, goes straight to your profit or loss statement. It can make for a much more volatile ride.
Now, let's get real for a minute. In the real world, not everyone pays their debts. Loans go bad. It happens. So financial instruments obviously have risk, and the accounting rules have to reflect that reality. And not just after a loss happens, but before. And that's where this idea of impairment comes into play. This was a huge shift that IFRS-9 brought in. It's called the Expected Credit Loss Model, or ECL. The old way was you'd basically wait until there was clear evidence a loan was in trouble before you recorded a loss. But now, companies have to look into the future. They have to estimate the losses they expect to have based on probabilities of default and account for those potential losses right now. It's a total game changer.
So how does it work? Well, it's a 3-stage model. Think of it like a risk escalator. In stage 1, everything's looking good. The credit risk is low, so you only have to book a provision for losses you expect in the next 12 months. But if the risk on that loan suddenly increases in a big way, you jump to stage 2. Now you have to recognize all the expected losses over the entire life of that loan, a much bigger number. And stage 3? That's when things are actually credit impaired. You've got real evidence of a problem. So the idea is simple. As the risk goes up, the loss you recognize on your books goes up too.
Oh, and one quick but really important note. These impairment rules, they don't apply to those assets measured at fair value through P&L. And there's a really simple reason why. Just think about it. If the market gets worried about a company's ability to repay a bond, what happens to the price of that bond? It goes down, right? So that loss is already captured in the fair value. Adding another impairment on top of that would just be double counting the bad news.
Wow, okay. We've covered a ton of ground, right? From the basic definitions to classification, measurement, and now impairment. It can feel like a lot of technical rules. So let's zoom out. Why does any of this stuff really matter? What's the big picture?
So here's the bottom line. All of these rules, they're not just there to be complicated. They all work together to tell a story that's hopefully consistent and transparent. It all starts with that first choice, classification, which is basically the instrument's destiny. Then, the measurement rules decide how much of the market's drama gets reflected in a company's profit. And finally, the impairment model makes sure companies are honest and looking ahead at potential risks. The whole point is to give investors and anyone looking at the financials a clear, reliable picture so they can make smart decisions.
And I guess that's the really powerful idea to end on. You know, it's easy to see this as just a bunch of dry rules for accountants, but it's so much more than that. These rules directly shape the profits a company reports. They shape how stable we think a company is. They shape investor confidence. And when you think about that on a bigger scale, you start to realize that these accounting standards have a huge, real-world impact on our entire view of the economy. It's pretty wild when you think about it.